Welcome back to the Options Insider's exclusive coverage of the 2010 Options Industry Conference. Coming up next, we have a panel session entitled Globalization, International Perspectives. The moderator for this session is Michael Peters from Eurex, and the panelists include Emir Al-Rawi from IMC Financial Markets, Jorge Alegria from the Mexican Derivatives Exchange, Paul Maley from Deutsche Bank Securities, and Jim Shapiro from the Bombay Stock Exchange. Thanks again for listening to this session, and be sure to stay tuned to theoptionsinsider.com and Options Insider Radio for more exclusive coverage of the 2010 Options Industry Conference.
As the global markets are becoming increasingly connected, it is even more important for the U.S. options industry to be aware of trends and developments occurring around the world. We are very fortunate to have such a distinguished group of panelists who have flown in literally from across the world to join us here today. My colleague Michael Peters from Eurex has graciously agreed to moderate. Since 2006, Michael has been a member of the Eurex Executive Board. As a board member, Michael is responsible for sales and marketing, including business research and for corporate business development in Asia and the Middle East. In addition, he is responsible for Eurex's representative offices in London, Chicago, Zurich, Paris, and Beijing. Michael?
Thank you very much, Bruce. Welcome, everybody, and it is my pleasure to introduce you to the distinct panelists that we have today here on the stage. I think that is a very good mixture of the different markets that we would like to introduce. We have the emerging markets represented here with Jorge from Mexico, with Jim from India, and on the other hand, we have two truly acting international organizations, IMC as an international market maker and Deutsche Bank as an internationally acting investment bank. Before I start, I would like to introduce everybody here on the panel. On my left-hand side, we have Emir Al-Rawi. He joined IMC Financial Markets as a managing director in 2005. Prior to joining IMC, an international market-making firm with offices in Europe, the US, Australia, and Asia. He was the managing director for the Netherlands Options Traders, a market maker on the Amsterdam Options Exchange. He was also a floor manager and a senior trader for Timberhill Europe. Next to Emir, we have Jorge Alegria. He is the CEO of Mexta, the Mexican Derivatives Exchange. He previously served as CEO of ABN AMRO Securities Mexico and as Executive Vice President at Scotiabank Invalid. Jorge is also a professor at the Mexican Institute of Technology, and he serves on top of that as a member of the Board of Directors of IOMA, the International Options Market Association. Next to Jorge, we have Paul Maley. He is the Chief Operating Officer of the Global Equity Derivatives at Deutsche Bank. And Paul began his career with Deutsche Bank in Frankfurt, working in the fixed income derivatives area in 1998. The following year, he repatriated to London and worked in a number of client-facing functions across the equity asset class. In 2004, Paul was relocated to New York to develop the North American equity derivatives franchise further, and he returned to London to take over his current position in July 2008. And then next to Paul, we have Jim Shapiro. Jim is head of market development at the Bombay Stock Exchange. And Jim joined the Bombay Stock Exchange in September last year with responsibility for market development, institutional sales, and the exchange international relationships. Jim is a member of the Exchange Management Committee, and before joining the BSE, Jim was a senior managing director of Galileo Global Advisors, a New York-based boutique investment bank, and CEO of Galileo Bank Securities. Prior to joining Galileo, Jim worked for 16 years at the New York Stock Exchange in various management positions. So having introduced all these gentlemen, I would like to kick off the discussions now. I think what we have seen and heard during the last 2 days was a lot of conversations, discussions about the crisis and the impact of the crisis. On the other hand, I think we have also all seen the recent results that were posted by the financial industries, and these were actually record results. My question would be to all of you, how was your business, how was your organization impacted by the financial crisis? And looking at 2010 and ahead, what type of growth and recovery tendencies you could already see in your organization and in your marketplace? We might probably start with Emir from IMC, the market-making firm.
Perfect. Thank you very much, Michael. I think for IMC, we've seen a large transformation primarily in the risk management space. Starting out in 2008 when the financial crisis occurred, we had some large movements in a lot of equities, and we were, we always based our risk on certain parameters, and naturally all those parameters went out of line. As an example of that, when we were examining our local risk, we'd examine it at a 2% move and a 20% move. Well, markets moved 60, 70, 80%. Some companies went bankrupt. That was one area that we had to focus on, saying, what are we doing? What do we have to do differently? Well, we have to manage our risk a bit better. The other factor that played an important role was a concept that was, people knew about, but never really focused on, and that was counterparty risk. In our European and in our Hong Kong offices, we did some OTC trades with some counterparties. And in 2008, when things went a bit crazy, well, all of a sudden, the fact that some of these firms could have, and some of them did go under, made us take a look back and say, okay, is it important that we execute these trades? And what can we do to bring these trades back onto the marketplace? So those were the two areas, I think, from a risk management perspective that we truly focused on. One other one, for example, would be that a lot of our offices were managing risk locally, and that's also changed. Now we have a risk committee. We report our risk to a risk manager here in the U.S., using U.S. as an example. He reports to a global risk manager in Europe. Our head office is in Amsterdam. And he has bi-weekly meetings with the board to let them know what our risk exposure is worldwide. So on the risk side and the counterparty side, those were extreme changes in our business model. The third one, and this is one that's going to keep on going, is that a lot of firms like ourselves, liquidity providers, high-frequency shops, were very much internally focused. So we were, sort of media shy. If people asked for comment, we would not really provide one. And I think in the last year and a half, 2 years, the way our business has been, frankly, decimated by the public or by the media, and the fact that the public doesn't really have a very, very good idea of what we do. We've reached a point where, as a firm, not only in Chicago but worldwide, we're exposing ourselves to the marketplace. We're going to talk to journalists. We will be releasing public comments on issues that concern not only us as a firm, but our business as a whole.
Jorge, what is your view as a market operator, in particular in a very interesting emerging market in Mexico?
Thank you, Michael. And I want to thank also for the organization of this conference and for inviting me. I have to say that I'm thrilled to be in a panel of globalization in Arizona. So that's just to break the ice a little bit, no, but it's so I have my passport here just in case. But talking about the globalization, I think we have been doing a lot of efforts in the Mexican market to attract international players. But talking about what happened on the during 2008, 2009? Well, obviously we saw the decrease in volumes. I guess the volatility increased the value at risks in the books of our main participants, and then the volume decrease. We are starting to see a clear recovery, but we have to say also that our concern is a little bit a lot of that recovery is going into the OTC markets. So that's something on which we are trying to work together with the authorities and the biggest players, but we forget too soon about what happened and the advantages of an organized marketplace and the advantages of accessing a clearinghouse. But, interest rates went down sharply. The traders made a lot of money, I think, and equity prices are coming back fast. The Mexican economy is growing, so the activity is again there. The traders can move very easy to one market to another, specifically talking about organized trading places against pure OTC places. And we have a little bit of concern about considering the investor base in Mexico, the international base. What our market model should be in this environment? Should be move into a OTC traded market with a CCP and central clearing, or is all these millions of dollars of investment in technology to provide millisecond execution, or is worth it? Obviously, I believe it is worth it, obviously, but it is our concern that this recovery in volumes has been faster than we expected, which is, I think, a good thing. But our concern is that this recovery is a lot in moving into the OTC space because it's easier to trade there, it's a little bit less transparent than maybe some brokers and dealers may want to do that. So this is a little bit the environment in which we are moving right now. It's a recovery scenario, which is good, but the OTC space is taking a bigger pie.
Paul, would you share the views from Emir and Jorge, or as an global acting institutions, do you have different views?
Yeah, I think I have a slightly contrarian view to what Jorge was just saying. As an industry, I think we've done probably not a great job of already advertising how much of our business is already centrally cleared. So if we just take equity derivatives, so my background, 55% of global notionals are already centrally cleared. In the interest rate space, 70% of the interdealer market is already centrally cleared. So this is not a new thing. And this thing that, as whether or not the legislation is as tough as we expect on both sides of the Atlantic, this is something that's only going to become more and more common as time goes by. It was very interesting to hear the exchange leaders panel yesterday describing those same trends from their perspective. I think the crisis is often best viewed from the perspective of the client. Many banks had seen themselves very much in the kind of the warehousing business, and now we've kind of, through the contraction of balance sheet and in the reduction in value at risk, we're far more in the moving business. Clients during the crisis became very, very afraid of counterparty risk, as Amir was already saying. And DB was a relative winner in that space because we never had any taxpayer funding at all. It wasn't necessary for us to recapitalize. So we had clients actually flocking to get into DB's kind of exposures out of their current kind of prime brokerage and clearing relationships because they wanted to have kind of our credit. But that didn't obviously stop a shift into the listed market as well. Certainly from the taking into account that we are at an options conference, it also drew an awful lot of new users into the options space who previously hadn't touched it at all. So customers wanted overlapping portfolio hedges. They wanted to know far, far more about how to use puts as a way of protecting their exposures. And that's something that those clients have stayed. They haven't kind of gone back to their comfort zone. The other experience that we had from customers was kind of two other overwhelming trends. The first one is that they went from being, often very global players into far more localized in their terms of their focus. They withdrew from emerging markets extremely aggressively. Big American hedge funds and asset managers who previously had decent exposures in virtually every jurisdiction suddenly became extremely U.S. focused, and the same was witnessed in Europe as well. The second thing was this kind of flight out of complexity. During the kind of market between 2000 and 2007, clients had wanted to get alpha, they'd wanted to get outperformance through complexity. So they'd gone more and more into structured products, more into long-dated kind of options, and more into exotic payout formulas. And what clients did is they got out of those exposures at often kind of fire sale prices, and they shifted more of their balances into far more transparent products that were more duplicative of things that we see in the listed markets. And secondly, it was far more short-dated. So you almost saw a shift in the kind of maturity bucket of volatility from the kind of like 4 to 5 year kind of expiry, much closer to kind of like 1 to 2 year. And I think that's something that is actually, certainly the exotic business is unlikely to come back in the foreseeable future.
Thank you, Paul. I think from the global view to a marketplace where I think everybody is looking at from the potential, from the demographics, what is your view on the financial crisis and the impacts when you in particular look at India, Jim?
Well, it's a little bit paradoxical how India kind of went through this whole period. On the one hand, there are a few countries that kind of weather the storm better, and that creates a lot of kind of confidence in the systems and infrastructure, at least among the regulators, that they're doing something right. On the other hand, there were some major impacts. One is it sort of shattered the myth that there was some decoupling. Clearly, they were very impacted in terms of the performance of the market. The market dropped 85%, one year and came back another 85% the next year. So their price movements were very dramatic. There were some volume effects. I mean, clearly, some people pulled out of the market. Definitely, the international participants, as you just mentioned, pulled out of the market significantly. But I would say the long-lasting effect is that or the sort of medium-term effect is that the regulators they were always fairly conservative. It's an emerging market. It's developing very quickly. It's broadening beyond equities to all these different asset classes. Now, for the first time, we have currency derivatives, interest rate derivatives, equity derivatives are pretty well established, but still at an early phase, and very few products and product development. Exchanges are pushing for product development, and the regulators are kind of holding us back. The turmoil in the international situation makes the regulators a little more cautious in the short term, although they recognize that things have evolved and matured to a point where they really are ready to let go and let the exchanges innovate and develop. But had there been no crisis, the last 2 years would have been, I think, very dramatically different in terms of their degree of relaxation. So it's sort of delayed everything a few years. The delay came from the point of view of the international participants, because 3-4 years ago they changed the rules and allowed 100% owned subsidiaries among broker-dealers in India. So everybody rushed in and restructured, and Goldman, J.P. Morgan, everybody kind of now has a fully 100% owned subsidiary. Then the crisis hit, and everybody just set up shop, just started to ramp up, and they pulled everybody back, shut down essentially for 12 months or even 24 months, and now they're all rebuilding. That's having a big impact because the level of sophistication and the bringing in of international practices in terms of high-frequency trading and smart order routing and all of the things we're very familiar with in this market are now just really beginning to come to India, and they would have come probably a year or two earlier had there been no crisis. So I think it's that a sort of a temporary delay. And then one final thing, I think what it's done is it's kind of broken the sheen of the international marketplaces, and they were much more unthinkingly looking to the U.S. and Europe for models and patterns and practices. Now they're being much more cautious. I mean, they're still looking at them, but they're trying to use their own judgment of, is what they're doing make sense? Should we follow it? Should we do something different? Because look where that got them. And there's much more of that kind of attitude among the regulators, which it can be a problem because it can slow down again kind of the speed of the evolution, because they're a little more nervous about allowing things like co-location, for example. I mean, they're scratching their heads. They didn't know what it was 3 or 4 months ago, and now they're trying to understand it. And then people throw around words like that they don't understand, and it makes them nervous. So now they're studying it more intensively.
Jim, you elaborated on the behavior of the international investors, and we have basically 2 truly acting organizations here, Deutsche Bank and IMC. I think it would be probably interesting for us and the audience to understand better what are the key decision makers for these global organizations to enter the emerging markets, and how you assess and overcome the potential hurdles within the regulatory framework. On the other hand, it's probably also interesting to understand what type of regulatory framework you offer in Mexico and India to support foreign investments in your country and to boost the liquidity in the respective markets.
Let me just respond to something that Jim said. I think in the past, when the financial crisis hit, a lot of the focus that we had developed for expansion plans relatively changed. I mean, we have to keep in mind it was in 2008, going into 2009, markets were collapsing, and we started talking to people around our competitors, some of the clearing firms and so forth, and literally people felt that it was going to be the end of our business. We were anticipating a volume drop on the options space of 25%, and that didn't really materialize. But what did it do for firms like ourselves? We decided to hold back a bit, focus on the strategies that currently exist, and weather the storm. Basically, that was the whole concept of IMC. So all the expansion plans that we had going into 2008, end of 2008, and going into 2009, were put in the back burner. Now, 2010 is upon us. We've seen the markets stabilize, markets rallying, volumes picking up again. Not as bad as anybody thought. So then we start focusing on expansion. So where do we look at? Brazil would be one example where we're starting to look into Mexico, Canada, and there are a lot of opportunities out there. And our business is in general relatively scalable, but we do run into problems. One is connectivity. As a liquidity provider, IMC relies on its speed, efficiency, technology, and we cannot really rely on third-party vendors to provide us direct access to some of these exchanges. So that's an issue that we have to deal with. And finding programmers. I mean, I'm sure many of you are familiar with firms like ourselves, but it's difficult to find very good programmers out there because we're all competing for the same group of people. So the time frame of when we decide to go to an exchange, an emerging market or another exchange, a foreign exchange, and having to develop the API can be quite long. So time frames are one of them. Tax. In 2009, October 2009, Brazil instituted an inflow tax of 2% out of the blue. It shocked the markets a bit. Is this possible in other emerging markets? I'm not familiar with how it is in India or in Mexico, but there's concerns like that we would also have to approach. Is there a tax for capital inflow, outflow of tax? Then one of the other things that we look at is arbitrage opportunities. Some of these products have ADRs. They're cross-listed on different exchanges. So then we take a look and say, what's the volume? Can we arbitrage the one stock versus another on 2 different exchanges, and so forth. So those are the type of things that we look at.
Paul?
Obviously, from a bank's perspective, yes. Your cost of carry when you are in any market is kind of much higher. When we're looking at the kind of smaller offices that we have, they have to be able to stand on their own 2 feet. So this isn't about a model of having just a representative sales office in an individual jurisdiction. I mean, the big projects that we're running specifically within equity derivatives at DB this year are in Turkey and in Korea. Those businesses are expected to be able to stand on their own 2 feet, and the analysis that we go through is to see how we can make money, not necessarily from actually international access, but from actual domestic customers in those markets. So, Turkey and Korea are good examples. They have very kind of a younger demographic, which tends to be a growing middle class that is highly educated, already a high proportion of equity investors that live in those countries who hold it within their own accounts. And you look for those kind of trends within the populace of those countries to decide whether or not it makes sense to even be present there. Then you get into more of the issues that Amir was already referring to around what the regulatory environment is like, what the tax situation is going to be. Then you have to go through a painful process of applying for all of your local licenses. That can often be a 1 or a 2 year process, and you have to commit for the long term. I was very glad that obviously Jim didn't mention us as being one of the firms that withdrew from India, because I know we didn't. But those clients remember when you look after them during certainly the experience that we've had in the markets recently, and they'll stay with you for the longer term. So if you want to have the higher margin business, particularly for kind of local corporates, they expect you to provide the bread and butter business around clearing and custody services extremely well. But those services are very, very difficult and very, very expensive to set up. And they obviously don't tend to make a lot of money in isolation. So those are the kind of the key metrics that we look for.
And Jorge and Jim, I mean, how do you attract foreign investments in the regulatory framework that is, of course, provided by the local regulator? And what can you do as a kind of market operator on top to attract foreign business, foreign member firms? And how important are they for your business?
Yeah. Well, I think that despite that we are losing market share with the OTC, that's just a temporary issue, because we have a market, a model that I think is going to work very well, and is working now. Let me give you one of the examples on the very good regulatory issues that we made. We have a very open-minded government that has been helping us a lot. First, when we realized that we needed much more active international participation in the local market for 2 reasons. First, the development of the local investor base is still developing. Second, the Mexican banks, the Mexican intermediaries, if we can call it Mexicans, we have a Deutsche Bank, we have Bank of America, Merrill Lynch, Citibank, JP Morgan. Those are the Mexican banks. And for them it's very easy to connect with the head office in London, New York, Toronto, or Madrid.
Right.
So we need to put these 2 different players together. The most efficient way to do it is allowing fully owned subsidiaries in Mexico, or moving even one step forward, that is to allow remote membership. So we fully allow today remote membership, and people directly, we have people now trading from Chicago, from New York, from London, from Greenwich, Connecticut, directly connected into the exchange. Maybe we can talk a little bit about technology, but you need also to upgrade technology to allow that.
Right.
And we worked hardly on that before to allow the fixed interface. We have now people trading MexDer outside Mexico directly using RTS, using PATS, using GL Trade, or whomever proprietary screens they may want to use. We design our products on an international standards, not to try to invent anything new when appropriate, because obviously there are some instruments on that we need to, if the underlying is a Mexican instrument, you need to adapt that. But if it's an option contract, I remember having a lot of discussions with the banks and the clearing members on when we launched the options market just 3-4 years ago, when is the best maturity date for the options contract? So some people were saying on Tuesday, some people were saying on Thursday. We decided to move on the 3rd Friday of the month. Why? We don't know, but everybody else is going that day, so we need to stick on that day and allow people to arbitrage our options contracts with the ones that are actually traded outside. And the third one, which is I think is very important, having a very friendly regulatory framework, is taxes. The government was very supportive, and they canceled and withdrew all withholding taxes for foreigners. So there's no tax frictions there. So the foreigners, Mexicans, or anybody can trade without any tax consequence attached. That's the kind of things that are recently in place, but we are sure that are going to be the foundations to make a very strong marketplace for trading Latin American securities with technology, friendly legal framework, no taxes. And if I may to add, the last thing is that is relatively recent, is to allow access through omnibus accounts. Right. So there's no need for Deutsche Bank, although they have a local presence. They don't need to open an account for each individual customer. They can be just Deutsche Bank Mexico, having one account called Deutsche Bank Frankfurt or New York, and everything is there. And that has been catching up very fast. That allows also margins to be deposited outside Mexico. The margins can be deposited in the U.S. or in dollars or in T-bonds even, because our clearinghouse has an account in the U.S., which is the owner of those securities. So that's the kind of thing that we are trying to push a little bit harder now after the financial crisis stopped us a little bit for obvious reasons.
Right. Jim, how does the world look like in India with regards to attraction of foreign investments?
It's a big topic, but let me just try to kind of sketch a little bit the regime. I mean, I think India is hugely attractive as an opportunity for international participants because, one, it's a big country, and there are very few as big with as big potential, and we're 10%, 8-9% growth rate foreseeable for the next 10 years is pretty much the sort of standard assumption people are using. So there aren't very many countries of that size, population, and sort of penetration potential. We still only have about 10 million equity investors in India. That's less than 1% of the population. So there's just huge opportunity to grow as the middle class grows and as participation grows. And it's a relatively open market for foreign participation compared, really, I would say, to the only other country in Asia that people compare it to, which is China. So it's relatively easy if you're willing to cross the threshold and come into the country, set up a subsidiary, play by domestic rules. It's relatively easy to do, certainly compared to China, maybe not compared to Hong Kong or Singapore, but Hong Kong and Singapore are not India or China. I mean, that's the problem. So that domestic, wind at your back, or that huge potential domestic market is a big advantage. The other thing is that it's still a reasonably, there are frustrations, it's complex, you got to invest some time and energy to come in and get the licenses and do whatever you have to do. But it's a relatively transparent, regulatory environment. I'm first to say it's not perfect because I spend half my time railing about the regulators when I'm back in Mumbai. But you look at this conference, we spend half our time railing about the regulators even in this country. So it's just sort of the nature of the business. And there too, strategy for the BSE is about 50% trying to anticipate how the regulatory environment is going to evolve because it's evolving very fast. But having said that, it's something people can work with. It's not a complete black box. The regulators are relatively accessible. They listen to foreigners. They listen to domestic participants. They're sort of trying. They're trying to figure out what makes sense and how to move forward. And having said that, the other really attractive thing about India is that it's a competitive environment. So it looks a lot more like Europe or the United States than any other market in Asia because you can start an exchange. There are competing exchanges already. There's 27 exchanges in India. I know because we just got the 27th license to start a currency and interest rate derivative exchange. Is number 27, which is a lucky number in India, so we're very happy about it. And many of them don't trade. Many of them are defunct regional exchanges that still have licenses, but many of them are new commodity exchanges, new commodity derivatives exchanges, some cash cash commodity exchanges. We have jute exchanges. I mean, some of these licenses are not, really, you're not going to hear about them in Frankfurt or London, but they are there. And who knows, just like in this country, some of these exchanges with a license will reinvent themselves. I think possibly with foreign backing and participation, and depending on how the rules evolve. So it's it's. I guess the bottom line is it's a relatively open playing field, and the foreigners are coming. We see this as the way the market will. Some elements of the market will grow very quickly. I mean, the final thing is I think that the attitude towards foreign participation is relatively healthy. It is not extremely protectionist. It's not like, who are these people to come here? I mean, just like I think Mexico, when you see, J.P. Morgan in India, it's 100% Indian. I mean, there's nobody, and people realize that allowing these firms in is a way to import the, global practices and talent and train people, and it's very positive for the development of the market. So, I think all those are very positive things. There's still some frustrations and difficulties of actually operating in the market and coming in, setting up shop. And I know there are tax concerns, there are complexity issues, there are other problems. But by and large, I think it's starting to really work, and you see the arrival of more and more firms every month.
Right. I think when listening to you, I mean, we observe that on the one hand, there is kind of harmonization, alignment with international standards. You mentioned FIX, you mentioned remote membership, you mentioned regulatory standards, you mentioned competition between exchanges. I think on the other hand, we also observe still fundamental differences between the different marketplaces or different regions, actually. When we, for example, look in Europe, look at Europe and the US, and the customer profile, the customer flows, I think on the derivatives market, in particular in Europe, they are very much driven by institutional business, and that also determines the execution spot where it's actually executed, mainly due to the institutional order flow via big chunks in the via the block trade functionality and not in the order book. Whereby in the US, the order flow is very much driven, at least 50 to 60%, by retail investors, and we have a very liquid and deep order book. When we look, on the other hand, to the market maker models, we have still in Europe a pro rata market making model. In the US, we see a clear shift to a maker-taker model. When we look at the market infrastructure, clearinghouses in the US, a strong consolidation to two utilities for the equity market and the equity options market, whereby in Europe we have a total different model, organized for profit, still almost to a certain extent domestic, national level, to a certain extent European. Do you think that, these type of developments will still remain in the future? That means we will have, I would call it, regional, domestic specialities, or would you think that the harmonization process or the development according to international standards or in one direction to one model will continue? Or how do you see that, and how do you anticipate the development? Paul, you might probably have a view on that, as I think from an operational point of view, you need to take that into consideration almost, I think, on a daily basis. Yeah?
Yes, I previously would have, before the crisis, this is something that would have been driven by investor appetite for different types of risk. You obviously already mentioned the strong retail presence in options in the US. Clearly, that doesn't necessarily exist in the same flavors in Europe. People tend to trade optionality through warrants and certificates that are traded on stock exchanges. The market is just as large and just as liquid, but it trades in a very different kind of market structure. Now that the crisis has happened, and certainly we're seeing through the bills going through the Senate at the moment, that's going to be mostly driven by regulation and legislation going forwards. So the kind of very obvious differences between the way that US market structure has existed in the past and the way that European market structure has evolved in the past are likely to start to get more and more commonality, and regulators are looking for those shared rule amendments, etc., in everything that they're doing, where previously those discussions weren't even really taking place. If I had to kind of anticipate today the way that those two things might get closer and closer together, I think we will start to see more commonality in terms of Europe shifting slightly more towards the US kind of model in terms of pre-trade transparency, into the way that crossing becomes less and less easy to do, and the post-trade regulations, either through trade repositories or through the way in which trade reporting happens, even on exchanges, gets more and more easy to see what's actually been going on. So that is likely to be dictated to us, I think, depending on what the legislation looks like on both sides of the Atlantic. I think what we'll begin to see first is the idea of this central clearing mandate, and then the question will then become, how products get chosen to move into the realm of standardization, so they get selected for clearing, and then as a natural consequence of that, the emphasis will shift more towards pre-trade transparency and how the price discovery process works.
Would you agree?
Yes, I would, but I'll approach it from a bit of a different perspective, and that is that if you look at where we were 10 years ago and where we are right now, 10 years ago I was training on the Amsterdam Options Exchange, and you tended to notice that the exchanges in general dictated the terms to you as a market maker. Okay, I was a local, I was small, but the exchange would say, this is what we're going to do, this is our pricing model, and too bad, you had to accept it. Now we move down the road, I come to the US, and you start seeing that there's different exchanges with different technology, different pricing models, and so forth. But if I look at how much it's promoted this business and how much more we're getting out of the competition of these exchanges, you go, wow, it's not too bad for a firm like IMC. 5 years ago, the whole concept of make or take was relatively an unknown concept, or relatively small. In this day and age, we've seen several exchanges, one exchange started with that business model, several exchanges are switching to that type of model. And what you start realizing is that competition is good between exchanges. I think it's a very important aspect of our business. The other thing that you tend to notice, and I've met with a lot of exchanges both here and abroad, and in the past, liquidity didn't seem to be that important to the exchanges. That's the feeling I had. Now, liquidity has become such a hot commodity that exchanges are approaching us and saying, what can we do to promote your business or to bring your liquidity to this particular exchange or to this foreign exchange? We want you. It's really important, so we'll work with you. And I think that's a bit of a change in dynamic from, again, I'm comparing it to 10 years ago, but we've seen a significant change in that area.
Jorge, we learned that in Mexico it seems to be a kind of different tendency or trend compared to what Paul pointed out, because Paul mentioned, he expects to a certain extent standardization, CCP-supported transaction, to a certain extent transactions that will basically be standardized and will be transferred from the bilateral OTC market, not all of them as we all know, to the CCP and clearing world, whereby in Mexico we have the situation, as you pointed out, that actually the OTC business has been extended, at least recently. Yeah.
But that's again, I think I guess that the recovery has been more in the OTC markets more clearly in terms of volume than on the regulated exchange. But I think it's temporary. I really think it's temporary because, again, the world is going that way. When I said that, is that it was particularly in Mexico, and it was basically driven by the traders.
Right.
Say that it's easier for them just to pick up the phone, call his buddy, do the trade, send the fax or an email, and that I'm done. But the head of markets and the senior risk officers in upstairs, or in New York or London or Frankfurt, Toronto, whatever they are, Madrid, they will use Basel II kind of rules and whatever comes out from the US and Europe on the regulatory side. So we are seeing right now with a little of concern that the recovery is taking place faster in the OTC, but that doesn't mean that we are not going to be focused on our model. It's a little bit like frustrating sometimes in a very short term that you're investing a lot of money in technology to provide these market makers that are not in Mexico, by the way, provide access and very fast execution when the local players, they want to use the phone. That's a little bit, they're very short term, but that's going to change. And we are working not for the very short term, but we are working for the medium term and to attract the international players and to help us to develop the local players. So that's only just short term. And talking about market structures, right now the Mexican market is driven by institutions. There are very, very large institutions that are getting sophisticated. Pension funds, mutual funds are getting more sophisticated, and they like to use more the block trade. But at the same time, we found, and we are finding as we speak that to have the screen-based market makers are also increasing, because what these huge positions or huge participants are doing is opening a position in a bank or in a broker-dealer book. And all the adjustment for volatility of that position, those smaller trades, they take place on the screen, not on the big block trading facility. So I think it's going to be interesting, and I think we can definitely have both models in place at the same time.
Right. Jim, how do you see the market structure in India?
India is still a very heavily retail market. I mean, across the board. I mean, at least exchange-traded products to date. OTC obviously is different, and they're particularly interest rate products and others are still completely institutional and OTC, although they're starting to kind of move on to exchange as well. But what's happened, what you see happening is that the institutions would like to participate more, and sometimes they're able to do block trades, but they're really forced effectively either for cost considerations or because of regulations that are still a little bit cumbersome to do things offshore, OTC, and then kind of swap back into the position through a essentially somebody like Deutsche Bank or one of the global broker dealers who have an onshore presence and an offshore presence. So there's still a lot of that activity happening to gain exposure in India. But onshore, it's in equities, it's probably 60-70% retail trading every day. Maybe another 15-20% foreign institutions, and the rest is domestic institutions. Domestic institutions are still just very, very undeveloped. Mutual funds are pretty much. I mean, they're there. They're starting to grow, but in absolute terms and in relative terms, they're still very small in India. Pension funds also very, very small in India. Insurance companies bigger, but they're not allowed to trade in equities. So and most banks also not allowed into equities yet. So they're primarily holding government bonds and holding them to maturity. I mean, so there isn't even a lot of liquidity in bonds among institutions because it's just a buy and hold market primarily. So. And on the derivative side, and equity derivatives, and it's more or less the same picture. It's very heavily dominated. Now, interestingly, in India, futures, the concept of futures is very well established and has been around a long time. In fact, it was kind of banned on the Bombay Stock Exchange for various reasons. There was an institution called Badla, which was a kind of built-in cash/futures product with rolling settlement that people traded incredibly actively. It was tangled up in lots of problems of clearing and settlement, and when we were in physical paper and had a trading floor, and they basically banned it. And for a long time, there was nothing. Then futures started, and everyone, was like, wow, this is great. It's like bottle all over again, and people, very comfortable with the concept of sort of leverage and futures trading. Options has taken a little bit longer to catch on among retail, And in fact, it's still, I think, very, very early, and there needs to be a lot more education because the options participants are probably more heavily institutional, and there's more block trading in options and less kind of normal retail participation. But it's beginning, and we're pushing the introduction of warrants, which I think will have a big impact. We haven't got it approved by the regulator yet, but we clearly have a lot of support from the big international banks who have seen it successfully help build the derivatives markets in Hong Kong and other places in Asia, and they're very eager to bring it to India. So I think that's just a matter of time.
Right. I think one important element for expanding the business is technology. And you mentioned it already, the FIX protocol. You mentioned the importance of flexible risk management systems and the implementation of them during the crisis. And I think when we look at technology, we can look at them in two dimensions. On the one hand, the technology that is provided by the clearinghouses and the exchanges by the market operators. And I think we have seen here a clear tendency with regards to higher throughput, higher speed, co-location services. I would call it the transformation from milliseconds to nanoseconds, these types of trends. I think on the other hand, it's probably also interesting to see what type of internal investments are necessary by the banks, by the market makers behind the firewalls, and where do you see the developments going in this particular area? Yeah. You might probably elaborate on that, Emir.
Sure. I think just a small history of IMC will indicate how important technology has become in our industry. When I joined IMC in April of 2005, the operation in Chicago was 12 people, of which one person was what we call now a technologist. Fast forward 5 years, in 2010 we have 120 people in Chicago, and I would say a good 50% of those are technologists. We have people in what we call the front office developers who are currently sitting with traders and helping them develop some of the trading platforms. Performance engineers, people who are constantly looking at our speed and measuring it and making sure that it's optimized. I think what we're seeing also, and I've mentioned this before in past discussions, is this whole concept of a trader is now starting to converge. There is no such thing as a trader anymore. A trader is actually a technologist or a risk manager. Those two things are one and the same now. We still segregate them, but in 2-3 years from now, I would not see that occurring. Even in terms of the recruiting that we do and the people that we talk to now, we try and in the past we would hire people who were had a background in business administration, econ, finance. Now we focus on computer science, computer engineering majors. So we've seen a shift in that area. The other part of it is the cost of doing business. If you look at our budget, IT-related costs are a significant factor. I think it's number 2 after labor. And it's mind-boggling sometimes the numbers that you see that firms like ourselves pay for co-location facilities or for technology, in whatever area. It's just it's a tremendous burden on firms like ourselves.
Jorge, what type of next investments do you intend to do in the exchange and clearing space?
We have the co-location in place now. So we were a little bit biased at the beginning of locally. We didn't saw that necessity, but definitely for international participants is a key issue. So we checked that with the Mexican authorities, and again we got a very, very fast green light, and we are providing now co-location in our own site, to put it that way, and again together with the free access through FIX protocol it's an open API, so it's very convenient and very easy for international participants or local participants to get access. We use the trading engine, exactly the same trading engine as Spain. We bought the trading engine. We bought the technology from Spain, which is a proven technology in terms of functionality and speed, reliability, working in Europe. And we are working now in a heavy upgrade to be able to integrate both trading engines on equities and derivatives into the same trading engine, and then go to the 1 millisecond or sub-millisecond area. But obviously we are completely aware of what's going on, and we need to catch up at the same time with the regulatory changes that we have been able to get with the technology to provide with the international players looking for that kind of services. So we are already there with the colo as well.
Paul?
I think it's interesting to hear Amir's ratios for technologists to traders, because ours are even better. We have about 110 traders globally that work in equity derivatives. We have more than 250 technologists. So that's kind of exactly right in the way that the business is shifting. Interestingly, it's also seen how technology budgets have shifted certainly within firms, and we did talk, obviously alluded to this a little bit earlier on. There was a period, kind of pre-crisis, where you'd spend an awful lot of your time and money on externally facing technology. So it was market connectivity, it was client-facing solutions, be they websites or applications or front ends, and for co-location and things like that. The objective was to have 100% uptime, and everything had to trade at the speed of light. We're getting virtually very close to those kind of like perfect paradigms now. So it's almost now less important. So about 3/4 of our technology budget is on internally facing technology. So risk management systems, scenario analysis, shock testing, the ability to be able to anticipate, balance sheet and inventory and portfolio makeup in real time, and the ability to kind of manage those variables in far more sophisticated ways, and know what the shape of your book is in absolute real time, so that you can calculate your P&L very close to the moment that the market closes, are now the real objective.
Thank you, Jim.
Yeah, I know we're starting to run out of time, but I would just make 2 points. One is that I think we're in a competitive environment, and that's certainly accelerating investment in technology. There's no doubt about it in India. We see this as an opportunity to leapfrog our competitor, because in effect we're behind, and we're going to be investing aggressively, and so we're trying to do that in a sensible way and focus on the things that are, get the most bang for the buck, but also can be done quickly. In general, in India, the matching engine pieces are homegrown and fairly old, but also fairly robust. We're the number 2 exchange in India. We trade 6 million trades a day in the equity market. There's a lot of trades. Unfortunately, that's the good news, and do it very efficiently, and there's no big problems. The bad news is, there's a lot of one-share trades. One-share trades, in 100 rupee stocks. It's not, the regulations aren't kind of helping in terms of the use of technology in an efficient manner. We're kind of wasting a lot of capacity on very low value trades. We're focusing, I think, mostly, much more on new product innovation, and we have lots of challenges on front end connectivity. We're moving to Fix 5.0. We've already sort of adapted it. We're testing it. Clearly, making it easier for people to kind of access the market is a big emphasis. The matching engine itself is not the problem. I think growing capacity is a big issue. We're starting to see people auto quote in our options and futures markets for the first time. We've encouraged them. We're very actively trying to bring them in. When they start doing it, we realize that this is just a whole different ballgame than the past. The time, our order to trade ratio is almost infinite for these people, because they're starting to quote and there's not a lot of trading yet. But it puts pressure on the systems that we've never seen before. And I think we're very, very capable of responding and building the capacity in response. But it's, I think we're still at very early days of this pressure on the technology in terms of its development.
Thank you, Jim. At this point, I would like to ask whether there are any questions from the audience that would like to be raised. No questions from the audience. So you have a question, Bruce? Okay.
Michael, maybe
Can we probably hear Thomas?
Everyone can hear.
Okay.
Maybe everyone would want to opine for a couple of seconds on the timeline. Everyone's mentioned to one degree or another the regulatory barriers coming down. Jorge, you mentioned it. Jim, you mentioned it. Maybe a couple of seconds on what a realistic timeline looks like. There was a question in the early session this morning where there were some rocks thrown at the exchange community about access across borders. Michael and I can share with you as Eurex and ISE that the SEC hasn't moved all that swiftly on a link that we're trying to put in place. Your perspectives on what capital flows across borders face in the way of reduced regulation. What does that timeline look like?
I'll be happy to comment about India. I mean, one of the key difficulties of operating in India from offshore is still that there are currency controls in a limited way. And in effect, I mean, my personal view of it is that it's almost like a myth that exists, but the reality doesn't exist anymore. But the regulators kind of choose to kind of perpetuate the myth because they feel like it's in their interest to perpetuate the myth. So, I mean, in fact, FIIs or foreign institutional investors can bring in an unlimited amount of money and can take out an unlimited amount of money as long as they're registered. And they do move significant amounts in and out of the market, and no one really gets too upset about it, and it happens. But there is still this regime in place, and it gives people the perception that the central bank is in control of the currency. I think that will go away. The time frame is probably 2 or 3 years before I think they're confident enough to say we really have a floating exchange rate and we really don't need controls on the capital account anymore. But as I said, I think it's almost more of it's a perception of what's really going on. I mean, there are still some controls in place, but for very large transactions, you need an approval. When Tata Motors bought Jaguar Land Rover, for several $1 billion, they had to go and get someone to sign it at the central bank. But there's never any question that transactions like that are going to get stopped by a central banker. I mean, it's just not really going to happen.
On Mexico, I would just want to underscore that after several years of negotiations and everything, the Mexican market is quite open. I mean, literally, there's no controls at all. There's completely free float currency. The peso trades actively worldwide in terms of currency trading, not only at futures markets like CME, but also MexDer. But the peso is on the CLS, so it trades 24 hours a day with heavy volumes, and it's completely free convertibility. There's no withholding taxes that may affect trading from if you are investing from Brazil or if you are investing from the US. There's nothing affecting that, and you can have your broker or your FCM operation in Mexico or in Chicago or in New York or London. We have a very good relation with the Mexican authorities. The Mexican authorities supported all these with an MOU that they signed, that the Mexican authorities signed with the CFTC. And all the MexDer products are CFTC approved. So they can be distributed in the U.S. without any kind of additional regulation. That's the kind of things that are in place already. What we are now moving out a little bit more aggressively is to try to get international participants to help us to boost liquidity and help also to develop the local market.
Are there any further questions from the audience? This doesn't seem to be the case. Then I would like to thank the panelists, I would like to thank the audience, and I would like to thank the ISE for organizing this event. Thank you very much.
Thank you, everyone. Please join us in the main ballroom for closing remarks and the passing of the hammer ceremony. Thank you.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.